Now we're going to go through U.S. exports and what's happening around the world, because it's just like everything else, it's very bifurcated with Asia continuing to slow down. And we want to touch on why is that important when we think about Asia, where some of these shifts are coming in terms of refineries coming on, coming off. But first, let's just look at where things sit at the moment on week over week. So gasoline exports were down 148,000 barrels a day, still 172,000 over the 5-year average. Again, more naphtha, exports of naphtha from the U.S. into Europe is at a 9-month high. That's going to remain, and that's just pulling more in. So again, that's going to keep things elevated, because Latin America, we're just not seeing the demand coming out of LATAM, where when we look at disti was down 245,000 barrels a day, 288 below the 5-year average, kind of right in line with what we were expecting. But then propane was up 345,000 barrels a day, up back to about 1.5 million, 642,000 above the 5-year average. Again, that's going to remain very strong, just because the LPG demand is robust around the world, especially on the petchem side when you look at the cost of naphtha. Now, crude oil exports only increased 26,000 barrels. We were expecting a spike from that 2.46 million to about 2.8, and instead it came in at 2.489. So that just means that there's going to be another makeup number. So does that mean that we'll probably go to about 3 million instead of 2.8? I'm going to say yes. You'll start to see this. But again, as we look over the 4-week average, we expect to be between that 2.6, 2.8 level, and a little bit closer again to that 2.8 level. And the reason why is when we look at Dubai versus WTI. So you can see WTI took another leg down versus Dubai. Dubai is at almost a $4 discount when you look at just the spreads in general, which again is just keeping WTI, Brent, West Africa, all of that really capped. And then when you look at Iraq, so Iraq put SOMO on the market. So they said, look, here's your reoffer, and it's rare. It's not a common thing that they do. They do it every once in a while, and then people rush in, snap it up, and then look to resell, reoffer. And we're just not that. It actually came, went, and now they put it back on, and now they took a certain amount of restrictions out, and you're starting to see OSPs. So OSPs have been rising in the Middle East, and as we've been saying, and trying to explain to listeners and to those that want to learn more about it, OSPs are a starting point. You can go above, you can go below. It's just, where are we trending? And right now we're actually trending well below OSPs and getting further away from OSPs as we continue to see some additional capacity come into the market from the Middle East. Some of these slowdowns in terms of purchases, especially out of Asia, which is, again, just leaving more in the system, which is putting pressure on pricing. And that then calls into question, what are September OSPs going to look like? We've seen a pretty steady increase of OSPs, which are seasonally normal in terms of increases, but do we start to see some declines in terms of pricing, just because, trying to get closer to where the market is in general? So now when we flip to Dubai, here you can see it's a $4, it should be Dubai Brent spread. Here you can see that there's still that $4 discount. We're at the highs that we've been at from 18, 19. There's just, again, that demand for Dubai is where we're continuing to see this shift. So that speaks to the crude side and why we're going to continue to see our exports struggle. But now when we look at gasoline, you can see gasoline fell back within the clouds, still well above the 5-year average. Just based on what is being classified as gasoline and what Europe is pulling in, we expect to see this remain elevated and again, kind of go sideways again, staying at the top end of that cloud. Now, when we look at distillate has actually fallen on a seasonally adjusted level. It's actually fallen back below the seasonal norms. But as we were saying, it's going to touch the 5-year average, fall back below. So we just expect to see some of this movement sideways, just because Europe is not pulling in U.S. distillate. It's really that we're seeing more and more coming from the Middle East, as well as coming from Asia, and we're seeing that still come through, which is going to keep our exports fairly capped. Now, this is just looking at that crude oil export side to put it into context as to where it is. And then rounding that out, we just want to look at that 4-week rolling average. You can see that big drop. So now on the 4-week average, we're at 2.9 million, much closer to what we're expecting as we go through the end of the year. Now, we were expecting to see this type of level start in the end of June. Instead, it started in the beginning, in really the middle of July. And that delay is us being, a week or two early, but there's also that timing issue in terms of when is it getting released, when is the paperwork going through. So there's going to be a mixture of both that's going to keep us. But again, that's why just based on pricing, based on new flows, that's going to keep us at this fairly depressed level. While when you look at LPG and propane, propylene, back to the highs, continuing to push higher, elevated, staying elevated, really nothing to say new there. Now, when we look at refiners, we want to talk about the refinery dislocation, and this came from a shipping company that is looking at, I think it was ADC. But when you look at where refiners are being built, coming online, and where they're being closed, and this is one of the reasons why when people tell me that Asia doesn't matter, I just laugh because of course it does. This is where you're getting all new builds. Like this is where that new oil demand is coming from, and you're seeing oil demand going away in Europe, in Asia. Europe and the U.S. And it's just straight oil demand because refiners buy oil. They turn oil into product, and you can see where that shift is and how that shift has come over time. So when we look at Australia, we know that they've closed. You have more closures in Japan, but if you look at India, if you look at China, if you look at the Middle East, that's where we continue to see an additional capacity. And based on what we've talked about in our insights and in other shows, we're still 3 to 4 million barrels a day over with too much capacity. So we need to see about another, at least let's call it 2 million barrels a day come out of the market, which again is going to put us into a fairly, let's just say stable, where we're going to get more flow coming from Asia and the Middle East into Europe and the Americas, or let's just call it the Atlantic Basin and Pad 5. So this is again that longer term trend that we've been talking about for years, really starting to gain momentum. And I thought this was a very good slide highlighting how that has changed and how that continues to move products around the world differently. Now, just a quick update on India oil imports for June. You can see that it's the second lowest in the last 5 years. Obviously, 2020 was further down. China's gas oil exports have fallen to 1-year low so far in July, according to Kepler. Month-to-date volumes totaled 630,000 tons as of Friday. So when you think about India's coming down, and we're seeing that play out through July into August, getting better. So when you think about India, this is looking at imports for June. So May was above April, but then June was below May, and now July is going to be below June and May, and then we start to get some normalcy and some pickup in August, just based on what we've seen coming from West Africa. Because when we look at some of the numbers, and we'll talk about them in a minute, you're getting China buying a little bit less West African, but India buying a little bit more. So net for West Africa, everything is the same. It's just more is going to India versus China, so you're just getting a little bit of that push, which is supporting August flows versus July. Then when we look at gasoline exports for June, they're right in line with the 5-year average. So there's really not too much to report here. This is something that, again, we expect this to go sideways, but we are seeing some degradation of demand in India right now, which is going to put some pressure on July numbers after seeing, where things went in June, and then what we expect to see into August, as diesel exports set a new seasonally adjusted high, which when you look at just what the market is doing, we expect this to stay fairly elevated through the end of the summer, which is going to put more product back into Singapore, but we'll talk about that in a minute. Then when we look at India's overall fuel consumption, you can see that it was down by about 7.6% versus the 2019 levels. So India's crude imports are set for the lowest monthly total since September 2020 as product demand dries up, according to Clipper data. So now we're looking at another source here. Month-to-date flows in July have sunk to 3.65 million barrels a day, down from 3.87 million barrels a day in June and 4 million barrels a day in May, the data intelligence team said yesterday. So the weakness this month has come from the Americas with just one delivery from Colombia. Again, that's where some of the shifts have gone. Imports from the U.S. have also dropped with only 104,000 barrels a day of WTI Midland discharging this month. However, a rebound is set for August with 350,000 barrels a day of the grade set to discharge already in motion. Meanwhile, deliveries of Middle East ticked higher for a second month, and West African barrels are discharging at a strong pace. So again, that's the shift that we're seeing that we are going to start to see in August. Then when you look at India's diesel consumption, you can see that we're right in line with 2020, down 16.8% from 2019. India's oil refineries also cut crude processing in June due to lower demand for petroleum fuels and maintenance work at several plants. The nation's refinery processed 18.4 million tons of crude during June, a 3% fall from May, but almost 5% higher than a year earlier. So that's where you're starting to get some of that that benefit of that drop where you had the national lockdown, didn't get the lockdown, so you still had some of that, but that puts us at about 87 to 89%, which is still, seasonally low for that period of time. But now when you look at what's coming next, you look at petrol consumption, you can see that we're just 8.7% below 2020, a little bit higher than 2019, a little bit higher than 2020. So then when we look at Genscape, we had some big builds last week. Now we're seeing a little bit of a draw. This is, again, that timing delay we were talking about. We expect to come in this 7-year trend. So that's why this seemed too low. Now we have some of that coming back through. We expect to be just right within that 5-year average over time. So now let's just look at what's happening in the physical market, the loadings market. Schlumberger announced that they're going to drill 13 exploratory wells in Libya. And I think that's important to talk about because, the investment is happening. It may not be front page news. It may not be something that anybody really wants to come out and admit to be honest with you, just because it's a little, let's just say that you become front page news for all the wrong reasons with the ESG crowd. So, but there is investment happening behind the scenes and really in front of the scenes. It's just, you have to know where to look. So then when we look at Congo's increasing flow for September, taking it back up to a multi-month high. But one of the things that we wanted to talk about for a minute is Iraq's state oil marketer did an award a tender to sell Basra Medium for August 26th, 28th, and August 28th, 31st loadings via Platts, market on closed platform. Bids were as high as 15-cent discount to the grade's official prices before they were revised to discounts of $2 or more. So just think about OSPs, and again, the starting point. So this is for the end of August. So the end of August went from minus 15 cents to OSPs to minus $2. So this is what we keep talking about when we're looking at the Middle East and we're looking at some of this discount that continues to come through. Because remember, this is for August loading, the end of August loading. So that's taking us through July, through the beginning of August, loaded in the end of August, 4 to 6 weeks to get to the location. So now you're into October, another 4 to 6 weeks to sit in the tank. Now you're into November, December, and then you turn it into product. So you're seeing how we're already into 2022 when you're starting to look at some of these bids in general. Some Middle Eastern oil producers are witnessing crude, the crude pegged to their own OSPs sliding into discounts in the Asian spot markets. Oil refiners that are making good profits on some products are facing an uncertain period, again, with COVID-19. Other sales have also seen discounts. Iraqi Basra, as we said, Qatar, Iraq has jacked up its OSPs, but again had to come back down, with pricing for Basra Light and Basra Heavy now at the highest since February 2020 and September 2020, respectively, but now at a $2 discount. In contrast, spot cargoes from other OPEC producers that sell Dubai link grades, including the UAE, have seen relatively stable premiums versus where things are. But then we look at like Algeria, set OSPs at plus 25 cents, which is down from plus 35 cents. So coming down again. So you're seeing Iraq, Saudi coming a little bit lower, Dubai being fairly stable. Some Iraqi crudes now are at steep discounts. We're not seeing the same steepness coming out of Saudi, but they have more term contract. ESPO has fallen another 80 cents from where it was, now coming in below $2, where if you think they were close to 280. So you're seeing some of that erosion when you're looking at some of the premiums and some of the discounts coming in. Then when we look at West Africa, Asia exports, 64 cargoes are due to load for Asia in July, which is putting us about 1.93 million, which is a little change from June. Gunvor offered 100,000 tons of Urals at negative 260 Brent, which if you remember previously, it was at negative 245. Again, more slippage back down. And this is what we continue to see with Urals. Urals start the month at, let's see what we can get, and going up to, let's call it $2.25 minus dated Brent. And then as the month progresses, you see it get back to 260, 280, and at extremes, 325, just to kind of clear those cargoes. So then Rosneft is also reoffering about 12.63 million tons of Urals, which again is just putting more back into the market. And then when we look at exports in general, you're getting some increases in exports in general coming from Nigeria. And then we do have some deferrals in August going into September, because exports to gain for Forcados to 243,000 barrels a day from 219 in August. September's plan has 8 cargoes, including a consignment that was deferred from late August. So again, there's some shifts in general, some kind of highlighting where some of the softness is in the underlying market in general. So then when we look at light distillates and turn to Fujairah, you can see light distillates had that build that we were talking about, but middle distillate had another nice draw. And that's going to be the one to watch, because there's been a slowdown in refining, which has pulled some of this additional out of storage, because there is still that demand, there is still that premium, which is moving cargoes from Fujairah into the European theater. So that's going to be one to watch, with heavy disti, as we've been saying, just kind of hanging out here, which is kind of trending with builds in general. So when we look at July 26th, total oil products were reported at about 20.947 million barrels, falling below 21 million for the first time since May. Total stocks fell 807,000 barrels, with overall stocks falling 3.7% week on week. Light disti, including gasoline and naphtha, rose 454,000 barrels, up 7% on the week to 7.079 million, which is the first time they've been above 7 million barrels since the end of June. Gasoline east of Suez was finding support from bullish sentiment in the U.S., where stocks have been drawing amidst an increase of activity. But in Asia, China's crude throughput in July will likely fall slightly from the record high in June, as expected cuts from private refiners, which we'll talk about in a minute. So you're starting to see some of that shift in general. Asia softening, leaving some in there, some residual, some positive coming into the U.S., again, supporting some of those imports depending on where they're coming from. So Asia slowdown, U.S. increases in terms of imports. That should keep storage elevated in Fujairah, but again, still flowing into the Atlantic Basin. Stocks of middle disti, including diesel and jet, dropped 709,000 barrels, or 21.1% on the week, 2.659, the lowest level since April 6th of last year, when they stood at 2.5. Gas oil markets were seen largely range-bound with regional demand very sluggish, but it's offset by lower run rates leading to the constrained supply. So again, it's not a demand side. It's more, we're just not seeing the production on the refining side. And that's a shift between two things. One, they're just exporting it directly. And two, they're just doing a little bit less in terms of where those total flows are. And now when we look at Colombia, just came out right now, Colombia's heavy oil prices are at the deepest discounts of 2021. Physical prices of Colombia heavy to a 2021 low amid diminished demand from Chinese private refiners known as teapots. again, this is going to become a bigger issue. But the U.S., will just start picking some of this stuff up in general. So then when we look at stocks of heavy resid, they fell 552,000 barrels or 4.7% on the week to 11.209 million barrels. Bunker demand, as we've been saying, is rebounded and remains fairly steady. So now when we look at crude oil in the water, you can see it's back above the 5-year average or just right at the 5-year average. And that's because there's just more product in motion, which is something that we think is going to continue over the next few weeks as you have this elevated storage and guys are trying to clear that storage out and move it into the market, but really along that seasonal norm. And here's where we're seeing this, the oil in transit back to that 5-year average. That's where we're going to continue to see some of this movement going currently from storage to transit back to storage onshore. And that's going to be that natural trend, which this is just showing us what is eventually going to be in onshore storage, coming back to the 5-year average, but still elevated with some of this spits and starts on the demand side. And then when we look at floating oil storage, when we obviously take out 2020, you can see that we're still at a high, the second highest ever, even above where we were in 2016 and 2017 when the OPEC went into their little fight on market share. So now when we look at gas oil and just European products, you can see here that there was a nice draw across the board. NAFTA had a small build that should start to continue just because there's a big increase in imports coming from the U.S., but there's still a lot of demand, so that's going to stay fairly balanced. Gasoline, another small draw. We expect to start to see that level off a bit just with less European demand and just some of those impacts from the floods starting to abate because there were some issues on rivers moving barges around, moving cargoes around. Gas oil was down 197 tons. That's something that is we're not going to see a huge build. It's just we're going to see this gradual adoption of these imports coming through, replacing some of that with fuel oil. Again, they're trying to work through, and jet is going to stay fairly consistent. So here you can see kind of where we sit. Still some nice draws in gas oil. It's not going to come to the lows that we've seen in the beginning of May. But again, we're still moving in the right direction, and then it's going to start to increase, but not by a huge amount. Like we're not going to make up that disconnect from the 15-year average. Instead, it's going to be the gradual move as these imports come in over the next few weeks. Then when we look at gasoline, we're now back below the 15-year average, continuing to make these lows, which is also going to adjust the way exports are coming, which is why we keep talking about exports slowing. And this is going to start to build a little bit, but only to the 15-year average. Like we're not going to get this huge surge. It's just going to get back and kind of hold where we were on the 15-year level. Then when we look at ARO fuel oil, again, this is going to continue. They're trying to work this off. This should come into that average number as well. Now, when we look at Singapore, this is what we were saying. Again, Chevron pattern just going sideways. We expect, we could come back to the low that we saw in the beginning of May, back up to the highs of the end of April, and just work between that. We don't see any real drawdown, any real huge build. It's just going to be fairly stable. And the problem is right now, resid is the biggest driver, with middle and light distillates seeing some nice draws. But that's where we're going to see a little bit of a flip, where some of that middle distillate's going to come back out, light distillates. But if you look at what China is saying, how their exports are going to drop, you're going to see some of this. It's going to normalize in the sense where we're not going to go back to all-time highs, because you're just going to get less of that input or less of that need to store, given where things sit right now. So then when we look at international, the middle distillates, you can see we're right back to the 15-year average. And it's just something where we think we're just going to go sideways from here, using that 5-year average, that 15-year average as kind of the low point, not coming to the highs, but again, staying within that above that 5-year. And then same with light disti just going sideways at this point in time in terms of this movements across the board. Now, when we look at time spreads, here you can see some of these shifts. We're back to the highs when you look at September versus October. Just based on some of the softness in some of the spot markets and OSP markets going forward, we expect to see this come back a bit, but again, still remain elevated in general, which is the counterpoint to well, why are these spreads so strong if the physical market is a bit weak? And there's a lot of this spread activity that continues to sit in the system. More importantly, December versus December, where there's a lot of expectations that the December 22 is going to be much better, and that's where you continue to see a lot of this improvement. We think it's at its high, like we've seen the high, and it's really going to normalize a bit lower, but still stay elevated over, which again is going to put support into the front month. Even though really it shouldn't, but when you think about the way crude is being perceived, because let's just take a minute where if you're bullish crude, you'd rather be long further out because you're expecting some tightness, you're expecting all of these great things. Why would you be long the front month? Because if you're thinking about the future, you can get the front, you can get later, let's say mid-cycle at a discount to where front month is trading because we're in such steep backwardation, reverting back to the chart in segment 1. So these are some of those different setups and backdrops that we like to think about when in terms of positioning. So then when we look at Singapore, margins have gotten worse. They've gotten a bit better in the U.S. just given where some of the shifts are. But in Singapore, again, continuing to weaken, coming back to the issues that we continue to see in Southeast Asia with the Dubai hydrocracking refinery margins back to a seasonally adjusted, essentially low, is still consistent where it hasn't changed all that much for 2021. It's just the comps got harder, which is why it just looks worse. But again, you can see through 2021, it's been fairly fixed. Some of the margins, again, coming under a bit of pressure out of Europe for Urals, which is Northwest Europe, which is why we're starting to see Ural prices come back down to that 280, 285 discount versus dated Brent, likely to reach to about $3. Again, same thing kind of playing out when we look at the Med in the Mediterranean in general. And remember, Libya is bringing a bit more barrels back. And you're just seeing this whole component move further and further negative, which is just putting some additional weight on some refiners. China's supertanker crude imports back to the 5-year average, 4-year average. We don't, just based on these movements and these momentums, as we go into August, as we've been saying, that we're seeing some Chinese slowdown, some India pickup. So you're going to see this essentially follow that 5-year average, the 4-year average. I don't think it'll be as drastic as this drop, but it gives you an idea of kind of what we expect in terms of coming down, but going a bit more sideways and staying above that average instead of following it perfectly. Then when we look at refinery run rates, you can see that there's been a slowdown in Shandong Independence coming into about 71.4. It was at 74%. We expect to see this walking back a bit more as state-run refiners continue to operate at reduced rates due to seasonality, lack of slowing demand internally, as well as obviously our favorite floods, which we'll discuss more in our in Econ segment 1. Asian floating storage still high, as we've been saying, just kind of going sideways at this point, just in terms of what's showing up, that this disconnect still remains, and it's well below, obviously, 2020, but still well above where we have been over the other 4 years. Then when we look at North Sea, this had a nice reversal. We expect this to bounce back up, but again, still stay below this 5-year average, because our view was, again, going sideways until you get to the easier comp, which sits here at the beginning of September. West Africa has come back to the 5-year average, as we were saying, seeing some of those flow throughs. You've gotten some of those deferrals and some of those flows. So the deferrals allowed, so think of it this way: if you defer one cargo, you're not just gonna leave it on the water. You're gonna defer something that you haven't loaded yet, and then you're gonna sell that as something else and try to sell that to move and adjust some of your physical pieces and these chess pieces in the water. So this is something that, again, we expect to stay elevated and either setting new seasonally adjusted highs or at least staying above that 5-year average. Then when we look at Middle East, you can see that it's still slightly rising, but it's come back a bit. This is because you started to see those discounts accelerate, speaking to Iraq, speaking to some of these crudes, especially Dubai, that are really priced to move versus WTI versus Brent, which again is keeping some of these movements. But we see this storage continuing to trend higher as we're already trending at essentially 2020 and 2017 levels, which are still elevated due to obviously 2020 and COVID, and then 2017 from the market share fight. Here's where we look at Europe, which has gone sideways. As we were saying, we think it continues to go sideways a bit and marry and march right into that seasonal norm. And it's just going to be that timing delay in terms of when things show up, when they're loaded, and that's going to continue to be the case there. China, as we said last week, continues to see this elevated, still near seasonally adjusted all-time highs. And this is only going to get a bit worse because you're seeing refinery throughput come down, and you're seeing some of those pressures because remember they had their import quotas cut, so you're starting to see this kind of balance out as fuel oil stocks remain at 2021 highs. And if you look at seasonally adjusted, only 2014 was higher. So that's another thing that's going to be an overhang because they can use the fuel oil to crack into different products, trying to manage that in general. So that's all we have for you today. If you have any questions, we'd love to hear from you. We love the back and forth. Please like, share, subscribe. Your support is appreciated. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.